Right now, something is happening in the silver market that has never happened in the history of modern finance. JPMorgan, the bank that spent decades suppressing silver prices, the institution that paid almost $1 billion in fines for manipulating this market, has just executed the most dramatic reversal Wall Street has ever witnessed. They closed their entire 200 million ounce short position and accumulated 750 million ounces of physical metal. That's nearly an entire year of global mine production sitting in their vaults. But here's what nobody's telling you. This flip wasn't about profit. It was about survival. Because in 3 days, on January 1st, China is implementing export restrictions that will cut off 60 to 70% of the world's silver supply. The largest banks on the planet just realized they've been playing a game they can no longer win, and JPMorgan saw the writing on the wall before anyone else. What you're about to hear is not speculation. It's not a theory. This is the documented story of how the most powerful bank in precious metals went from the biggest bear to the biggest bull, and why that single decision confirms we're entering the most explosive phase of the silver market in 45 years. Let's start with what actually happened. Between June and October of this year, JPMorgan executed a trade that professional analysts said was impossible. For over a decade, they maintained the largest short position in silver futures, roughly 200 million ounces of paper contracts. Market watchers accused them of suppression. Regulators fined them $920 million in 2020 for spoofing and manipulation between 2008 and 2016. Their strategy was transparent: flood the futures market with paper silver, create an artificial supply, and keep prices contained. It worked for years, but something changed. Starting in June, JPMorgan began systematically closing every single short contract. By October 1st, they had 0 shorts for the first time in documented history. Simultaneously, they were accumulating physical metal at a pace that defied comprehension. Reports indicate they added 21 million ounces in just 6 weeks during the final phase of accumulation. Today, they control 750 million ounces, stored across COMEX vaults and ETF custodian facilities, where they act as the backstop for major silver funds. This isn't a hedge. This isn't diversification. This is the largest physical stockpile of silver ever assembled by a single institution. And it happened in complete silence during a period when silver prices were already starting their vertical ascent. Now, here's where it gets critical. The timing of this flip coincides exactly with 2 events that JPMorgan's risk management teams clearly identified before the public understood their significance. First, the United States officially added silver to the critical minerals list in November. That designation wasn't symbolic. It was a formal acknowledgement that silver is now classified as a strategic national resource on par with rare earths and lithium. The second event is China's export restriction policy announced on October 30th, effective January 1st, 2026. China controls 15% of global mine production, but refines and processes over 60% of the world's silver supply. Their new licensing requirement mandates that only large state-approved firms producing at least 80 tons annually can export silver. Smaller players are eliminated. Exports require government permission. This isn't a tariff. This is a supply cutoff designed to prioritize domestic consumption for China's exploding solar panel and electric vehicle industries. Shanghai silver inventories fell below 500 tons in November, the lowest level in a decade. China exported over 660 tons in October alone, a record, as exporters rushed to front-run the restrictions. Starting in 72 hours, that flow stops. Western vaults that were temporarily relieved by those Chinese exports will face an immediate and permanent supply vacuum. JPMorgan clearly modeled this scenario months in advance. They saw the Chinese policy shift coming. They recognized that silver's industrial demand profile had fundamentally changed, and they understood that once China locks down exports, the paper market they had dominated for years would become irrelevant. Physical delivery would become the only pricing mechanism that matters. So they made the hardest decision a short seller can make. They covered at a loss, converted to long, and went all in on physical accumulation before the Western market realized the rules had changed. This move wasn't just smart, it was an admission. The largest manipulator in silver history just told you the manipulation is over because the physical shortage has become unmanageable. Let's talk about what 750 million ounces actually represents. Global silver mine production in 2025 is estimated at roughly 850 million ounces. JPMorgan now holds nearly 90% of 1 year's total mine supply. But here's the more important number. Total above-ground silver inventories available for investment and industry are estimated at 1.5 billion ounces. JPMorgan controls 50% of that available float. They're not a participant in the market anymore. They are the market. This concentration gives them the ability to influence pricing, manage delivery schedules, and dictate terms to industrial buyers who are desperate for supply. And they're not alone. Reports indicate that other major institutions, including sovereign wealth funds and Chinese state entities, have been quietly accumulating physical silver throughout 2025. The visible inventories tell the story. COMEX registered silver, the metal available for immediate delivery, is down 70% since 2020. London bullion market vaults have lost 40% of their holdings. Shanghai inventories are at decade lows. The drawdown is accelerating, and it's happening during a year when silver demand reached 1.24 billion ounces, while total supply, Y including recycling, can only hit 1.01 billion ounces. That's a 230 million ounce deficit in a single year, the fifth consecutive year of structural deficit. Industrial users are panicking. Solar panel manufacturers need silver paste for photovoltaic cells. Electric vehicle producers need silver for battery contacts and charging infrastructure. Electronics manufacturers need silver for circuit boards, 5G networks, and data centers supporting AI infrastructure. Medical device companies need silver for antimicrobial coatings. Defense contractors need silver for missile guidance systems, radar, and communication equipment. None of these industries can substitute silver at current technology levels. When Samsung or Tesla need silver, they don't care if it costs $80 or $120 per ounce. They care about securing supply. And right now, supply is disappearing. The premium for physical silver over spot futures prices has exploded. In Shanghai, physical silver trades at premiums of $7 to $8 per ounce above COMEX futures. That arbitrage gap tells you everything. The paper price is a fiction maintained by traders swapping contracts they never intended to deliver. The physical price is the reality set by manufacturers who need actual metal. JPMorgan positioned themselves on the physical side of that divergence before it became undeniable to the broader market. Now let's address the regulatory angle, because this is where the story gets darker. How did JPMorgan accumulate 750 million ounces without triggering antitrust concerns or position limit violations? The answer is they used the infrastructure of the ETF market as camouflage. JPMorgan is the custodian for the iShares Silver Trust, ticker SLV, one of the largest silver ETFs in the world. As custodian, they hold physical silver on behalf of ETF investors. But the metal sits in JPMorgan vaults. They control access. They manage inventory. They decide what gets delivered and what stays stored. By accumulating through ETF custodian structures and COMEX warehouse receipts, JPMorgan built their position across multiple legal entities and vault locations, staying below the thresholds that would trigger CFTC position limit scrutiny. It's technically compliant, but structurally dominant, and there's precedent for this. The Hunt brothers tried to corner the silver market in 1979 and 1980. They accumulated through futures contracts. The CFTC changed the rules, forced liquidation-only trading, and the brothers went bankrupt when they couldn't meet margin calls. JPMorgan learned that lesson. You can't corner a commodity through paper contracts because regulators will change the rules to protect the system. But if you accumulate physical metal stored in your own vaults, there's no regulatory mechanism to force you to sell. You own real assets, not derivative obligations. The only way to get your silver is to outbid you or wait until you choose to sell. China's export restrictions create the squeeze JPMorgan was waiting for. Starting January 1st, Western manufacturers will face a binary choice: secure silver from non-Chinese sources at whatever price clears the market, or shut down production lines. There aren't enough non-Chinese refineries to replace the supply. Mexico produces 25% of global silver, but they don't have the refining infrastructure. Australia, Peru, and Canada are other major producers, but combined, they can't offset the Chinese export reduction. And even if they could ramp up refining capacity, it takes years to build that infrastructure. Chile is nationalizing lithium production. Other countries are implementing resource nationalism policies. The trend is toward restricted exports, not open markets. So where does that leave industrial buyers? They go to the entities that already hold physical inventory. They go to JPMorgan. And JPMorgan can now dictate terms: long-term supply contracts at premium prices, delivery schedules that favor strategic customers, market power that comes from controlling scarce resources during a supply emergency. Let's examine the technical signals that confirm this thesis. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing dramatically. At the start of 2025, the ratio was around 90 to 1. As of late December, it touched 66 to 1 during intraday trading. Historical analysis shows that when this ratio drops below 60, silver is outperforming gold on a relative basis, which typically happens during periods of industrial demand strength or supply stress. We're seeing both. Gold hit $4,500 per ounce, a record driven by central bank buying and monetary debasement fears. But silver doubled from $30 to over $70, massively outperforming. That performance delta tells you the silver move isn't just a monetary play. It's a supply shock, amplified by industrial panic buying. JPMorgan's trading desk saw this divergence building and positioned accordingly. Then there's the backwardation in futures contracts. Normally, distant futures contracts trade at a premium to near-term contracts because of storage and financing costs. But in tight physical markets, near-term contracts trade higher because immediate delivery is more valuable than future delivery. Silver futures exhibited backwardation during several periods in 2025, a signal that physical tightness was overriding normal cost of carry dynamics. Backwardation doesn't last long in liquid markets unless there's genuine scarcity. The fact that it appeared multiple times this year was a flashing red warning that the physical market was under stress. JPMorgan's accumulation strategy clearly factored in this signal. We also need to address the elephant in the room. What happens if the COMEX or other exchanges implement emergency measures to contain the price spike? There's precedent. In 1980, they moved to liquidation, only trading for silver futures. In 2022, the London Metal Exchange canceled nickel trades when prices went limit up due to a short squeeze. Exchanges have the power to halt trading, raise margin requirements to punitive levels, or force cash settlement instead of physical delivery. If they invoke force majeure, contract holders get paid in cash at an arbitrary price instead of receiving metal. This is the nightmare scenario for paper silver holders. You think you own silver through futures or ETFs, but when the squeeze happens, the exchange changes the rules, and you get dollars instead of ounces. JPMorgan eliminated that risk by holding physical. They can't be force majeured out of metal sitting in their own vault. This is the crucial distinction. Paper contracts are promises. Physical metal is a property. When the system is under stress, promises get broken. Property remains yours. China's export restriction is not just about silver. It is part of a broader strategy to weaponize critical mineral supply chains in the same way OPEC weaponized oil. China already implemented export controls on rare earth elements, tungsten, and antimony. Now they're adding silver to that list. The pattern is clear. As tensions with the West escalate, China is using its dominance in processing and refining to create leverage. They have watched the United States and Europe try to reshore manufacturing and build alternative supply chains for semiconductors and batteries. China's response is to lock down the raw materials that those industries need. Silver is essential for solar energy, which is central to Western climate goals. Silver is essential for electric vehicles, which are central to transportation electrification. By controlling silver supply, China can slow Western industrial transitions or extract concessions in trade negotiations. This isn't speculation. Chinese state media and policy documents explicitly reference securing critical resources for domestic use and limiting exports to strategic competitors. JPMorgan's intelligence apparatus understood this geopolitical dimension. They recognized that silver was transitioning from a freely traded commodity to a strategic resource subject to export controls and government intervention. In that environment, the only safe position is to own the physical metal outright, stored in jurisdictions you control. Once silver is classified as strategic, market dynamics change. Governments can requisition supplies, they can implement windfall taxes on mining companies, they can ban exports to certain countries. The only protection is physical possession in a stable legal jurisdiction. JPMorgan positioned for that reality. Now let's talk about what happens next. Silver opened at $25, around $30 per ounce. It's currently trading in the mid-70s with intraday spikes above 80. That's a 140% gain in a single year. Retail investors who chased the breakout at 83 got hit by a violent correction back to 74 as algorithms and profit takers sold into thin holiday volume. That volatility is normal in a market, transitioning from paper to physical price discovery. The question isn't whether silver goes higher. The question is how high and how fast. JPMorgan's position suggests they're modeling targets well above $100. If you adjust the 1980 silver peak of $50 for inflation using official CPI, you get approximately $120 per ounce in today's dollars. But if you use real inflation measures that account for housing, healthcare, and education costs, the inflation-adjusted equivalent is closer to $600 per ounce. JPMorgan doesn't need silver to hit 600 to make generational wealth on 750 million ounces. If silver goes to 150, they make $56 billion in profit on an asset they've held for months. That's a return that justifies every decision they made to close shorts and flip long. But there's a more subtle calculation happening. JPMorgan isn't planning to sell this silver into a rising market. They're planning to lease it. Industrial users who can't secure supply from traditional channels will have no choice but to borrow silver from entities that have it. Leasing generates ongoing revenue without selling the asset. JPMorgan can charge a percentage rate on leased silver, effectively creating a royalty stream on global industrial production. This mirrors what they do in gold markets, where they lease metal to miners and refiners, collecting fees while retaining ownership. If silver remains in structural deficit for years, which supply and demand fundamentals suggest it will, leasing becomes extraordinarily profitable. The metal never leaves your vault. You just collect rent from everyone who needs to use it. There's another layer to this. JPMorgan has deep relationships with defense contractors, aerospace companies, and technology firms through their investment banking and corporate lending divisions. They can offer preferential silver supply access to strategic clients, securing business relationships that extend far beyond commodity trading. If you're Boeing or Lockheed Martin and you need a guaranteed silver supply for defense contracts, having JPMorgan as your metal supplier creates a dependency that JPMorgan can leverage across multiple service lines. This is vertical integration at the highest level. Control the commodity, control access, control the client relationship. The mining sector is also watching this unfold with a mixture of hope and fear. Silver miners saw their stock prices surge in 2025 as metal prices rose. First Majestic, Hecla, Pan American Silver, and other producers are printing cash at $70 silver. Their cost of production averages around $20 to $25 per ounce. They're making $50 margins. That should be a windfall. But here's the problem. If JPMorgan controls the primary stockpile and China locks down exports, miners have limited buyers for their production. They can't just sell into the spot market anymore because the spot market is increasingly disconnected from physical reality. They need to take agreements with industrial users or with strategic accumulators like JPMorgan. And JPMorgan can dictate terms. They can offer to buy MMI production at a discount to spot in exchange for long-term supply agreements. Miners need cash flow and financing. JPMorgan provides both. This gives them leverage over the producers themselves, completing vertical control from mine to manufacturer. Retail investors and the general public are waking up to silver but facing a brutal reality. Physical silver is nearly impossible to buy at spot prices. Dealers are charging premiums of $10 to $15 per ounce over spot. Coins and bars are back-ordered for weeks. Online dealers crash during high-volume periods. Mints are rationed. The U.S. Mint announced silver coin shortages coinciding with JPMorgan's accumulation. That's not a coincidence. Wholesale buyers are draining the refineries and mints before retail investors can access the supply. If you're a small investor trying to buy 100 ounces, you're competing against industrial orders for 10,000 ounces and institutional orders for 1 million ounces. You're at the back of the line, and you're paying the highest premiums. This is the separation between the physical and paper markets. The screen shows 75. The dealer charges 90. That $15 spread is the real cost of scarcity. The ETF market presents another risk. Funds like SLV hold silver on behalf of investors, but they're structured as grantor trusts, not allocated accounts. You don't own specific bars. You own a fractional interest in a pool. If there's a delivery crisis and the custodian doesn't have the metal, you could face cash settlement or legal delays in getting your share. JPMorgan is the custodian for SLV. They hold the metal. If you own SLV shares, you're trusting JPMorgan to honor redemptions. But if they've leased out part of that inventory, or if they prioritize their own strategic interests, retail ETF holders are at the mercy of custodian decisions. This is why physical possession matters. If you can't take delivery, you don't fully own the asset. The broader macro environment supports higher silver prices regardless of supply tightness. Central banks globally bought over 1,000 tons of gold in 2025 for the third consecutive year. That buying reflects a lack of confidence in fiat currencies and sovereign debt sustainability. The U.S. federal debt exceeds $35 trillion. Deficits run over $2 trillion annually. The Federal Reserve balance sheet remains bloated from years of quantitative easing. When trust in fiat currency declines, hard assets rise. Gold and silver are the ultimate hard assets with no counterparty risk. Unlike bonds or stocks, they can't default or go bankrupt. In a debt crisis, which many analysts believe is inevitable given current trajectories, precious metals will be remonetized. They become money again, not just commodities. JPMorgan's silver hoard positions them to benefit from both industrial shortage and monetary crisis. It's the ultimate asymmetric trade. Geopolitical instability adds another bid. Tensions in the Middle East remain elevated. The Taiwan situation with China creates an ongoing risk. Energy markets are volatile. Supply chains remain fragile from pandemic disruptions and deglobalization trends. In unstable environments, governments and corporations hoard strategic resources. Silver fits that profile. It's essential for modern technology, it's in deficit, and it's controlled by a limited number of actors. Hoarding accelerates the shortage, which drives prices higher, which triggers more hoarding. This reflexive loop is already in motion. JPMorgan positioned itself ahead of the crowd. There's a final piece that ties this together. JPMorgan's decision to relocate their precious metals trading team to Singapore, according to market rumors, signals where it sees the future of silver demand. Asia is the manufacturing hub of the world. China, Japan, South Korea, Taiwan, India, and Southeast Asia dominate electronics, solar, and EV production. By moving trading operations closer to physical demand centers, JPMorgan gains logistical and informational advantages. They can negotiate directly with Asian industrial giants. They can manage delivery from Asian vaults. They can avoid Western regulatory scrutiny. Singapore is a neutral jurisdiction with strong property rights and a sophisticated financial infrastructure. It's the perfect location to manage a strategic commodity position in a multipolar world where East and West are increasingly decoupled. So here's what this all means for you. The silver market is no longer a simple supply and demand commodity trade. It has become a geopolitical chess piece, a strategic resource, and a financial asset undergoing the most significant repricing event in 4 decades. JPMorgan's flip from short to long is not just a trade. It's a signal that the rules have changed permanently. The bank that spent years suppressing prices just told you suppression is over. The physical shortage is real. China's export restrictions, starting in 72 hours, will accelerate the crisis. Industrial buyers are desperate. Retail supply is frozen. Prices are heading to levels that sound impossible today, but will seem obvious in hindsight. If you don't own physical silver, you are underexposed to one of the few asymmetric opportunities available in public markets. If you own paper silver through futures or ETFs, you're exposed to counterparty risk that could materialize when you least expect it. If you're waiting for a pullback to buy, understand that in a shortage, pullbacks are shallow and brief because every dip gets bought by industrial users who need actual metal. The time to position was months ago when JPMorgan was accumulating in silence. But the move is far from over. $100 is not the top, it's the floor. And when silver breaks through triple digits, the psychology shifts. Unit bias changes. Mainstream investors who ignored silver at 30 will chase it at 120. That's when the final phase of the rally begins, driven by momentum and fear of missing the greatest commodity move of the decade. JPMorgan knows this. They've modeled it, they've positioned for it. And they've done it with a scale and precision that confirms this is not speculation. It's strategic certainty. The emergency buy signal is already live. China's export ban is 72 hours away. The clock is ticking and the metal is disappearing. This is not financial advice, but it is financial reality. The silver market will never look like this again.